Honda just posted its first annual loss in 69 years. 69 consecutive years of profit, through recessions, through oil shocks, through 2008, broken this year. Not a bad quarter, not a rough patch. The full fiscal year closed in red ink for a company that hadn't seen a loss since before most of its own executives were born. That's the opening number. Keep it in your head. Stellantis, the parent of Jeep, Chrysler, and Peugeot, booked the largest single-year loss of any automaker outside a major global recession. Roughly $26 billion gone in 12 months. Not spread across a downturn. Not softened by a crisis excuse. One fiscal year, one number, $26 billion erased. The kind of loss usually reserved for the worst years anyone can remember. Porsche's profit collapsed 99%. Not down. Collapsed 99 cents of every profit dollar gone in a single year. The fallout forced Porsche to sell off its own stake in Bugatti, the ultra-premium hypercar brand it had spent years building up. A company known for margins other automakers envied just liquidated a piece of its own empire to steady itself. Land Rover and Jaguar posted the same 99% profit drop. Same year, different continent, identical number. And Ferrari, the brand that's supposed to be recession-proof, has seen its shares fall about 30% in just 6 months. If Ferrari's stock is bleeding, the idea that luxury car brands sit outside this problem stops holding up. Ford booked a $19.5 billion write-down. That single number killed several all-electric models Ford had bet the company's future on. Vehicles already designed, already funded, already promised to investors, cancelled outright. $19.5 billion is roughly what Ford spends on research and development for 4 entire years, wiped out to cover mistakes made chasing a strategy that stopped working. Here's the pattern, laid out in under 2 minutes. Honda, first loss in 69 years. Stellantis, worst single-year loss outside a global recession. Porsche and Land Rover, profit down 99%. Ferrari stock falling. Ford erasing $19.5 billion. 6 of the biggest car companies on Earth just had their worst year in a decade, at the exact same time. For about a century, the car market has functioned as an economic canary. Before layoffs show up in the headlines, before the broader economy admits anything is wrong, car companies feel it first. Because cars are the biggest purchase most households finance, and financing is the first thing that breaks. Call it the canary. Every failure in this video traces back to it. Here's what doesn't add up. 2025 US car sales hit their highest level since before the pandemic. Worldwide sales beat their old pre-pandemic totals. By every normal measure, this should be a strong year for car companies. So why is the canary choking in what's supposed to be a good year? That contradiction is the entire video. Sit with that for a second. These companies are bleeding billions during a year when more cars are selling than at almost any point since 2020. That's not a downturn story. That's something breaking while the lights are still on. So the real question isn't why this is happening now. It's what happens the moment sales actually start to slow down. This isn't a car buying guide. Nobody here is telling you what to lease or when to trade in. This is about what the industry's own numbers say about the economy sitting underneath your paycheck right now. The credit conditions, the debt load, the math that determines whether the next recession starts quietly in a factory town instead of on a headline. Cars matter as a signal for reasons that have nothing to do with cars. The auto industry anchors union jobs and a huge slice of the industrial base in multiple countries. And a car loan is one of the cleanest proxies economists have for household credit health. Approve someone for a 7-year loan and you've just measured how much debt an average family can still carry. Now look at the price tag. In 2019, the average new car sold for about $38,000. Today, it's just under $49,000. That's an $11,000 jump on the average vehicle in 6 years. Total industry revenue is sitting at record highs, even though the actual number of cars sold still hasn't caught back up to its old peak. So here's the sharper version of the paradox. Record revenue was never proof of a healthy industry. It just means the same shrinking pool of approved buyers is being charged more per vehicle. Fewer people can get in the door. The ones who do get in are paying more than ever. That's not growth. That's a smaller group absorbing a bigger bill. Which brings us back to the number that shouldn't exist. Sales climbing and profits collapsing are not supposed to travel together. One is the reward for the other. When they split apart like this, something underneath the business is broken, not the business itself. So the question for the rest of this video is simple. What's actually breaking and how deep does it go? 4 separate systems inside this industry are breaking down at the same time, and almost nobody is naming all 4 together. We're going to open each one in order, starting with the failure every CEO reaches for first on an earnings call, the easiest one to blame and the easiest one to misunderstand. The other 3 are quieter and worse. Call this level 1, the great flip-flop. For a decade, automakers poured billions into electric vehicles, promising all-electric lineups within years. Now they're quietly walking it back, delaying launches, writing down plans, scrapping targets. It's the official excuse on every earnings call, repeated so often it barely gets questioned anymore. But the flip-flop is a symptom, not the disease. Honda just posted its first annual loss since 1957, 69 years of continuous profit, broken in one reporting period. Trace the number back and it lands on the same place. Billions committed to EV production capacity the company built and now can't fill. Factories retooled for electric motors, batteries, assembly lines sized for demand that never showed up at scale. Stellantis is worse. A company that posted a $5.5 billion profit flipped into a $26 billion loss, one of the largest single-year swings in automotive history. About 25 billion of that is EV rated downs alone, nearly the entire loss. That's not a bad quarter. That's an entire electric strategy getting erased off the balance sheet at once. Ford's version, nearly $20 billion in total adjustments, and inside that number, its EV division alone lost almost $5 billion in a single year. Every electric vehicle Ford sells right now loses the company money on the sale itself. Not eventually profitable, losing money today, at scale, on purpose, because reversing course now costs even more than continuing. GM looks healthier on paper, still profitable, still cash flow positive. But look closer, it quietly scrapped its own 2035 all-electric target, the one it built its entire long-term strategy around, and wrote down $8.7 billion of EV investment. Profitable companies don't write off billions for fun. They write them off when the bet stops making sense. Here's the mechanism underneath all 4 write-downs. Cox Automotive Research found that a growing share of existing EV owners, people who already made the switch, are now considering going back to gas or hybrid. Not potential buyers who never converted. Actual owners, reversing. The mass demand automakers built factories for never fully arrived, and the ones who arrived aren't staying. Why did every major automaker make the same mistake at once? For a decade, investors rewarded anything that looked like Tesla with Tesla-level valuations. So legacy manufacturers chased that multiple. They looked at early adopter enthusiasm, the first wave of buyers who'll take any new technology, and mistook it for permanent mass market demand. That mistake got funded at industrial scale. There's a reason all these write-downs land in the same 12 months. Think of zebras crossing a river full of crocodiles. No single zebra wants to go first, but once the herd moves, every zebra crosses together, because getting picked off alone is worse than getting blamed together. Honda, Stellantis, Ford, GM. Nobody wanted to be the only one confessing. This isn't accounting theater. A plant engineered and tooled to build 1 million electric F-150s a year is worth a fraction of that number if it's only producing 10,000. The robotics, the battery lines, the specialized labor, all sized for volume that isn't there. These are real dollars poured into concrete and steel, sitting mostly idle right now. This isn't Detroit's first blind spot. The 1970s oil shocks blindsided the big 3 the same way. Built for one world, ambushed by a different one almost overnight. But there's a question nobody's answered yet, and it matters more than the write-downs already on the books. What does it actually cost to run 2 full production systems at the same time? Here's the answer nobody wants to say out loud. Research, tooling, and parts mostly can't be shared between a gas platform and an EV platform. 2 separate supply chains, 2 separate engineering teams, 2 separate certification processes. That roughly doubles fixed costs, and it's happening while total unit sales still sit below where they were before the pandemic. Which brings us to level 2 badge erosion. This one is quieter than write-downs and harder to put a number on. But it's arguably more dangerous, because it's not about a bad bet, it's about the slow collapse collapse of the one thing luxury car makers were actually selling all along. Not the car, the badge on the hood. Here's the part the industry doesn't advertise. A $200,000 car does not cost anywhere near that much more to build than a $40,000 one. Better materials, tighter tolerances, sure. But the real gap between those two price tags has never been manufacturing cost. It's been the badge itself, the exclusivity, the story stitched into the leather. That story is what's now eroding. Here's what that margin actually looked like before the erosion. Porsche ran an operating margin near 19% in 2024. Automakers usually fight for single digits. Ferrari's numbers are stranger. Unit margins run past 50%, meaning every single car rolling off the line in Maranello nets close to $250,000 in pure profit. That's not a car business. That's a printing press wearing a spec sheet. That profit sits on top of a ladder, and the ladder used to make sense. A Porsche GT3 costs roughly twice a base 911. That base 911 costs roughly twice a BMW M3, and the M3 costs roughly twice a 320i. 4 rungs, 4 price doublings, and for decades, each rung bought you a real, measurable jump in performance. The ladder was the product. Electric motors broke that ladder. A motor either spins or it doesn't. There's no decade of combustion engineering standing between a cheap one and an expensive one. So now the same spec sheet, over 1,000 horsepower, 0 to 60 in 2.5 seconds, shows up on cars, separated by hundreds of thousands of dollars. The rungs are still labeled. The distance between them just stopped being real. Ferrari's answer to this problem is called the loose, and by most published metrics, it's slower than cars that cost a fraction of its price. Slower than a Porsche Taycan. Slower than a Tesla Model S Plaid. Slower, embarrassingly, than a sedan from Xiaomi, a company that made phones before it made cars. The badge is still there. The performance gap it used to guarantee is gone. Put the numbers side by side and it gets worse. The Lucid Air Sapphire beats the Ferrari Luce on horsepower. It beats it on 0 to 60. It beats it on range. And it does all three for roughly $391,000 less. Same category, same customer wallet. One car objectively outperforming the other at a fifth of the sticker price. So why does Ferrari still sell out? Same reason a $5,000 handbag sells out next to a $40 bag that holds the same amount of stuff. Nobody's buying leather capacity. They're buying the story stitched into it. Heritage, scarcity, craftsmanship as theater. Performance cars ran on that exact same story for 100 years. The difference is, the story is now the only thing left holding up the price. And that story thins at every price point, not just the top. A Corvette ZR1X beats a brand new Lamborghini on almost every measurable spec for half the money. Meanwhile, mainstream cars increasingly share the same Bosch sensors, Harman audio, and Philips headlights under different badges. Cars are edging toward pure appliance status, the way nobody picks a laptop by brand anymore. So here's level 2 of the collapse, stated plainly. If anyone can buy the exact same numbers for half the price, what's left to justify the gap? Right now the answer is still story, badge, scarcity, vibes with a paint job. But stories require belief, and belief erodes the moment enough people stop paying the premium. The real question isn't whether that story is thin, it's whether it holds forever. Which brings us to level 3, and this one's bigger than any single brand. Call it the China problem, the market nobody in the West can out-engineer anymore. For decades, Western automakers treated China as a factory floor and a growth market, somewhere to sell finished cars and source cheap parts. That arrangement just quietly flipped, and most boardrooms are only now admitting it out loud. Here's the part that keeps American buyers confused about all this. The US barely feels it. America lives inside its own car bubble, walled off by trade barriers that go back to the 1960s. The so-called chicken tax, a 25% tariff on imported trucks. It's a big reason an F-150 practically doesn't exist as a European car. Different continent, completely different set of rules. Europe and Japan don't get that shelter. Their automakers depend far more heavily on exports to stay profitable. And for 2 decades, China was the single fastest growing, most profitable market either region had. Volkswagen, BMW, Mercedes, Toyota, Nissan. All of them built their growth forecasts assuming China kept buying, and kept buying their cars specifically. That assumption is the thing currently collapsing. Because Chinese brands didn't stay embarrassingly cheap. They got genuinely competitive, fast. Xiaomi, again, the phone company, delivered over 400,000 vehicles in its very first full year of production and outsold the Tesla Model 3 inside China itself. That's not a rounding error. That's a phone manufacturer beating the company that invented the modern EV on its home turf within 12 months. Add a nationalism factor, most Western analysts underweight. Chinese consumers increasingly prefer buying Chinese, and the export math turns brutal. China shipped over 1 million vehicles into the EU alone in 2025. BYD by itself delivered 2.6 million vehicles, close to 20% of the entire global EV market. One single company. Western automakers aren't losing market share to a rival. They're losing it to an ecosystem. Want to see what happens with zero protection at all? Look at Australia. No domestic car industry left to defend, no tariff wall, no chicken tax, just an open market deciding on price and spec alone. Chinese brands are winning there almost purely on cost, climbing the sales charts fast enough to worry legacy dealers who, a decade ago, wouldn't have named a single Chinese automaker. Give China its due for a second. Beijing didn't just watch this happen. It co-invested directly, subsidies, cheap land, cheap credit. But strip the patriotism out of it. Washington and Brussels run the same play, just with better PR, tax credits, loan guarantees, direct bailouts. And here's the part that gets skipped. China has let more EV startups collapse than America has ever had car companies, period. The clearest tell that this threat is real isn't anything American automakers have said. It's what European regulators actually did. The EU slapped tariffs of up to roughly 45% on Chinese-made electric vehicles, a number that big doesn't get imposed as a precaution. It gets imposed when the math already shows domestic manufacturers losing outright on price, on margin, on speed. If you're the kind of person who wants the receipts before this shows up as a headline, that's what this channel is for. Subscribe now, and you'll see the next collapse coming before everyone else does. Now, back to the mechanism, because tariffs only address the exporters. They do nothing about the market that's still wide open, the one bubble left that hasn't been forced to compete yet. So ask the real question. America is the last major market still sealed off. Tariffs, quotas, distance, all of it standing between American dealerships and Chinese pricing. What happens to sticker prices here the moment that wall comes down, even partially? What happens to the hundreds of thousands of American manufacturing jobs built on margins that Chinese competitors already proved they don't need? That question about jobs and prices doesn't have a clean answer yet. But there's a fourth system converging on it right now. And this one isn't about China at all. Call it the debt wall. The financing math that's been quietly coming due underneath every other problem in this industry. All of it at once. For buyers and manufacturers both. Here's the mechanism. Millions of car loans written during the cheap money years, 2020, 2021, were locked in near 0% interest. Those loans are expiring now, and when the owner goes to refinance or trade in, they're not walking into the same market. They're hit with a much higher interest rate stacked directly on top of a much higher sticker price, both at the same time. The scale of that jump isn't small. Between 2022 and 2023, the Federal Reserve took its benchmark interest rate from near zero to over 5%, the fastest hiking cycle in 4 decades. Auto loan rates tracked right alongside it. Anyone who financed their last car at 2 or 3% is now staring at 7, 8, sometimes 9% on the exact same purchase. Put a number on what that does to a household budget. In the first quarter of 2026, the average monthly car payment in America hit $773. Not the price of the car, the monthly payment alone. And 1 in 5 buyers now signs up for $1,000 a month or more every month for years, before insurance, before gas, before a single repair. To keep that payment from looking even worse on paper, lenders stretch the loan itself. The average new car loan now runs longer than 90 months, 7.5 years of payments on a machine that starts losing value the moment it leaves the lot and keeps losing it every single month of that entire term. That structure was always going to break somewhere, and it's breaking in the data already. The 60-day subprime auto delinquency rate hit 6.9% in January 2026, the highest level recorded in more than 3 decades of tracking this number. That's not a soft warning sign. That's the actual default wave already underway, in real time, right now. Delinquency is only the visible part. Look at trade-ins, and roughly 31% of people rolling into a new vehicle are doing it underwater, owing more on the old loan than the car is worth. The average gap sits around $7,200, quietly folded into the new loan, so the debt just compounds forward instead of resetting. Now layer in the twist that's specific to the exact bet these companies just made. Electric vehicles lose 58 to 59% of their value over 5 years. Gas-powered cars lose 45 to 46% over that same stretch. The technology automakers pivoted the whole industry toward is punishing owners in resale value faster than the cars it was supposed to replace. And it's not just households carrying this exposure. The manufacturers are leveraged the same way their customers are. Ford alone carries roughly $163 billion in debt on its books, and interest payments on that debt now eat up close to half of the company's free cash flow, money that used to fund the next generation of vehicles. And underneath all of it, one more structural fact is quietly working against every number in this system. Cars are lasting longer than they ever have. Average vehicle age on American roads keeps climbing every single year. So the exact moment fewer people can afford to trade up is also the moment fewer people even need to. Demand is shrinking from both directions simultaneously. Here's the open question. What happens to an industry built on a constant upgrade cycle? Trade in, finance, repeat. Once the loans can't stretch any further, and the existing fleet just keeps running instead of turning over. Average vehicle age on US roads just hit a record. A business modeled on turnover has no answer for a customer who simply stops showing up. Put it in one frame. The flip-flop, billions burned reversing an EV bet nobody fully committed to. The badge erosion, luxury margins vanishing as performance gets cheap. The China problem, an entire tier of competitors the West can't legally let in. The debt wall, payments and delinquencies climbing at once. 4 systems failing at the same time in what should have been one of the strongest sales years since the pandemic. This is the payoff on the canary. It was never one gas killing it. It's 4 different ones, released into the same mine, at the same time. The flip-flop cutting off cash, the badges losing their premium, China closing the export door, and the debt wall crushing demand from below. The bird doesn't know which gas to blame. It just stops singing. Some context, carefully framed. The auto industry has led downturns before. In 2008 and 2009, GM and Chrysler needed roughly $80 billion in federal support just to survive, not go bankrupt outright, survive. This isn't a claim that we're repeating that. It's the same warning light on the same dashboard, and the industry that flashed it last time is flashing it again. This was never a video about whether you should buy a car. A $773 median monthly payment and a 6.9% delinquency rate aren't a car story. They're a reading on the credit conditions sitting under everyone's paycheck, whether you drive or not. When lenders start losing money on car loans, that stress doesn't stay contained to car loans. It spreads. Go back to where we started. Honda's first loss in 69 years. Stellantis' record loss. Porsche and Jaguar Land Rover down 99%. At the time, those looked like 4 unlucky quarters, 4 companies making 4 separate mistakes. They weren't. They were 4 symptoms showing up on 4 different bodies, all infected by the same system. The canary in the mine doesn't get a resolution scene. It doesn't get rescued, and nobody comes to fix the air. It just goes quiet, mid-song, and the miners who were paying attention are already moving toward the exit. That's the whole video, in one bird. That's the canary.